Welcome to CryptoverseXplorers. Today, we're exploring the world of blockchain fundraising with our episode, ICO versus STO, Understanding the Difference. In this deep dive, we'll dissect two of the most popular fundraising methods in the crypto space. From their origins to how they operate and their impact on investors and project creators, we'll cover it all. Understanding ICOs, initial coin offerings. ICOs, or initial coin offerings, revolutionized blockchain fundraising by offering a new way for projects to raise capital directly from a global pool of investors. Unlike traditional funding methods, ICOs enable startups to bypass the rigorous and regulated capital raising process required by venture capitalists or banks. In an ICO, investors receive tokens, which can be seen as the digital equivalent of shares, in exchange for established cryptocurrencies like Bitcoin or Ethereum. These tokens vary in their rights and functions. Some grant access to the project's services, acting like a ticket or a voucher, while others might represent a stake in the project's future profits, akin to traditional shares. The versatility of token design is one of the unique aspects of ICOs, allowing projects to tailor them to their specific needs and goals. The rise of ICOs can be attributed to several factors. The success of projects like Ethereum, which raised funds through an ICO in 2014, demonstrated the immense potential of this fundraising method. The relative ease and speed of launching an ICO, compared to traditional fundraising, also contributed to their popularity. However, the world of ICOs is not without risks. The lack of regulation has led to cases of fraud and scams, where investors were left with worthless tokens. Projects have also failed due to poor execution or unrealistic goals, leading to significant losses for investors. We will explore both successful and unsuccessful ICOs, analyzing what worked, what didn't, and the lessons learned from these experiences. The emergence of STOs, security token offerings. As the ICO market started facing regulatory challenges and growing skepticism from investors, the blockchain industry saw the emergence of security token offerings, or STOs. STOs address many of the regulatory and compliance issues associated with ICOs by offering tokens that are explicitly recognized as securities. These tokens represent ownership in an underlying investment asset, like stocks, bonds, or real estate. STOs bring the advantages of blockchain technology to traditional securities. This includes increased liquidity, fractional ownership, and the potential for a global investor base. By tokenizing securities, STOs provide a bridge between the traditional financial world and the innovative potential of blockchain technology. The legal framework surrounding STOs is more stringent than ICOs, as they must comply with securities regulations. This compliance provides greater protection for investors and adds credibility to the offering. However, it also means a more complex and costly process for the issuing companies. We'll delve into how STOs navigate the legal landscape, the implications for issuers and investors, and why they are increasingly seen as a viable alternative to ICOs. Comparing ICOs and STOs. When comparing ICOs and STOs, it's important to understand their distinct legal, financial, and operational implications. ICOs are often utilized for their speed and accessibility but come with higher risks and less regulatory oversight. They are suitable for projects that aim to build decentralized networks and require a utility token for their ecosystem. STOs, on the other hand, offer a more regulated and secure investment proposition, making them attractive to traditional investors and projects looking to tokenize real-world assets. Investor rights in ICOs are generally limited, as utility tokens do not confer ownership or claim over the company's assets or revenues. In contrast, STOs provide investors with rights similar to traditional securities, such as voting rights or a share in profits. This fundamental difference affects the risk profile and potential rewards associated with each. For project developers, choosing between an ICO and an STO depends on their project's nature, their need for regulatory compliance, and their target investor base. Each method has its advantages and challenges, and the decision must align with the project's long-term strategy and goals. Regulatory landscape for ICOs and STOs. The regulatory environment for ICOs and STOs is complex and varies significantly across different countries. In this segment, we explore how various jurisdictions have approached these blockchain fundraising methods. Countries like the United States have implemented stringent regulations for ICOs, classifying many of them as securities and thus subjecting them to federal securities laws. This approach aims to protect investors from the risks associated with unregulated offerings. On the other hand, some countries have embraced these innovations, creating a more conducive environment for ICOs and STOs. For instance, Switzerland and Malta have established themselves as crypto-friendly hubs, with clear and supportive regulatory frameworks. These differing approaches reflect the global uncertainty and debate over how to classify and regulate digital assets. The evolving regulatory landscape directly impacts the future of blockchain funding. Striking a balance between investor protection and innovation is crucial. This segment will feature insights from legal experts specializing in cryptocurrency, who will discuss the current trends in regulation and their implications for the future of ICOs and STOs. Impact on blockchain funding and adoption. ICOs and STOs have had a significant impact on blockchain funding and the broader adoption of blockchain technology. ICOs, in particular, played a crucial role in the early stages of blockchain development, providing a quick and effective way for projects to raise funds and build their ecosystems. This method democratized access to investment opportunities but also brought challenges such as market volatility and regulatory scrutiny. STOs have contributed to the maturation of blockchain funding by offering a more regulated and structured approach. They have attracted a different class of investors, including institutional players, who were previously cautious of investing in the less regulated ICOs. The introduction of STOs has also led to the tokenization of traditional assets, bridging the gap between conventional finance and the blockchain world. Both ICOs and STOs have influenced investor behavior, with an increasing focus on due diligence, project viability, and legal compliance. They have also spurred the development of new blockchain technologies and platforms, as projects strive to meet regulatory standards and investor expectations. Future of fundraising in blockchain. The future of blockchain fundraising looks to be dynamic and innovative. As the industry matures, we can expect the emergence of new models that blend the benefits of ICOs and STOs while addressing their shortcomings. These might include hybrid models, offering the flexibility of ICOs with the regulatory compliance of STOs. A significant trend to watch is the rise of decentralized finance, DeFi. DeFi platforms are experimenting with novel fundraising models, such as liquidity mining and yield farming, which could redefine how projects raise capital. These models leverage smart contract technology to create more decentralized and transparent funding mechanisms. The evolution of fundraising in the blockchain space will likely be influenced by ongoing regulatory developments, technological advancements, and shifts in investor sentiment. The industry is poised for further growth and innovation, with new opportunities and challenges on the horizon. Considerations for investors and developers. For investors and developers, navigating the world of ICOs and STOs requires careful consideration and understanding. Investors should conduct thorough due diligence, assessing the project's team, technology, business model, and legal compliance. Understanding the risks and potential rewards of each investment is crucial. Developers considering an ICO or STO must be mindful of the regulatory landscape and structure their offerings accordingly. This involves not only compliance with relevant laws but also transparency and communication with potential investors. Choosing the right type of offering is key, based on the project's goals, target audience, and legal considerations. Both investors and developers must stay informed about the latest trends and regulatory changes in the blockchain funding space. Adapting to these changes and recognizing promising opportunities will be critical for success in the evolving world of blockchain fundraising. ICOs and STOs represent significant developments in blockchain fundraising. They offer unique opportunities and challenges for the crypto community. As the landscape continues to evolve, staying informed and understanding these differences will be key for success in the blockchain space. Thank you for joining us on CryptoverseXplorers. If you enjoyed this deep dive into ICOs and STOs, don't forget to like, subscribe, and share your thoughts in the comments below. Stay tuned for more insights into the ever-changing world of blockchain and cryptocurrency.